Hey everyone, Texas Instruments is an interesting semiconductor stock and one that I've been following for several years. In fact, it's one of the most profitable companies in the world. So I'm a little bit concerned about its latest decreases in profitability. So I wanted to take a closer look at, what's going on with Texas Instruments, and that's what I'll do in this video. I'll highlight a little bit of what's going on in its latest quarter and latest year, and then I'll take a longer term perspective and show you what's been happening at Texas Instrument for the last several years. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in the latest quarter, revenue came in at 4.1 billion and gross profit came in at 2.4 billion, or 60% of revenue. From a year ago, gross profit decreased primarily due to lower revenue, higher manufacturing costs with planned capacity expansions, and reduced factory loadings. Gross profit margin decreased by 650 basis points. But interestingly, planned capacity expansions. Texas Instruments believes that they're in a cyclical downturn, which is turning around and it'll turn upward. And they're planning for that upward increase in industry demand. Now, this is a cyclical industry. Semiconductor industry is cyclical overall. Goes up with the economy, goes down with the economy. And so lately inventories industry-wide have been elevated, and so demand from end users has decreased, but Texas Instruments believes that's going to rebound, and so they're planning to be ready for when that industry rebound happens. They're going to be ready for that, and they can capitalize on that opportunity. Still, operating profit of 1.5 billion, 38% of revenue is a solid percentage of operating profitability, but still it was down 30% from a year ago. And looking longer term, Texas Instruments has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand why that's important, you can see Texas Instruments longer term 41.85% operating profit margin, up from a little over 25% in 2015. So longer term, they've demonstrated strong growth and strong economies in scale. Near term, they're under pressure given this cyclical downturn, as you could see in their operating profit margin moving downward significantly in the last year. Moving on, the company said cash flow from operations was 1.9 billion in the quarter and capital expenditures were 1.1 billion. They also increased their dividend per share by 5% in the fourth quarter, making our 20th consecutive year of dividend increases. Boy, passive income investors must love that, right? When not only are you getting the dividend payment, but you're also getting an increasing dividend payment. That's why I often say when I'm following dividend stocks, it's not as important to look at the current dividend payment, the current dividend yield, but it's more important to look at the next 5, 10, 20 years on the potential for the company to increase the dividend per share. Now, 20 years of dividend increases, investors that bought Texas Instruments stock 20 years ago are getting a significantly higher dividend per share than they were 20 years ago. So it's important, if you're planning for your future, planning for retirement, to start early and get into these dividend stocks early, because 20, 30 years later, if they continue increasing their dividend per share, you'll be left with a solid passive income to live off of in retirement, or to just supplement your regular income, whatever your preference is. And finally, I wanted to look at Texas Instruments valuation, and I use the forward price to earnings ratio very often. Here's why that's important as a valuation metric. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive, or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive, because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So Texas Instruments is trading at a forward price to earnings of 25.8, which is about average for where it's been in the last several years, going back to 2021. Although, given that its prospects are not great going forward in the next year, I would say, the stock feels a little bit expensive right now. Given that its profitability is decreasing, its revenue is decreasing, I wouldn't want to pay an above average valuation or average valuation for Texas Instruments stock right now. I would want something a little bit lower, something a little bit closer to a forward PE of 20, I would say, for Texas Instruments. But still, it's an excellent company because of the significant profitability, over 40% operating profit margin, even though it's on the downturn. The company does expect to rebound higher. And so if it does achieve that feat, you're going to get a very profitable company at a reasonable price. This is not a cheap price, it's a reasonable price. Still, this is one that I would just be putting on my watch list right now, not buying at these valuations. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.